I turned a $22,000 investment in Apple into over $100,000 despite all the negative press from Wall Street analysts about Apple over those years. Lucky? Well, maybe. I'll take a little luck anytime it comes my way. Luck is generally defined as success or failure brought about by chance, rather through your own actions. In this video, I'm going to give you a way to think about companies you want to buy in the hope for achieving a targeted future rate of return that involves less reliance on luck and chance. Because chance, well, is a wrapper or a spot on the monopoly board, not a long-term stock market strategy. Welcome to MGA Investing. My name is Dee. It's true, no one, including me, has a crystal ball and knows exactly how a particular stock will perform over a given year, much less 5 or 10 years. But what if I told you that you may not need a crystal ball? The reason for that is that success, well, it often leaves clues, and often they're right there, right in front of you. All you need is to focus your attention and mute the noise around you. I want to share with you a little bit about my decision-making process that allowed me to buy, hold, and even add to my Apple positions in these last 6 years, and what also led me to buy another 25 shares in May, even though Apple was already one of my largest positions in my portfolio. Why do you think so many Wall Street analysts and people in general seem to misunderstand Apple? It's an important question, and the answer will give you maybe some insight into the way I think about owning companies. If it's not ignorance, then it has to be emotions or motive. When I say emotions, what I mean is that people sometimes form strong emotions about things that are, well, more emotionally based than rather fact-based. It's been my experience that the market, well, it doesn't really care about your feelings. From a motive perspective, I'm referring to Wall Street's persistent disapproval of Apple because, well, Apple will not play the quarterly earnings game to the extent that Wall Street desires. I know there are Apple haters out there for a variety of reasons. All I know is I've owned Apple products most of my adult life, starting with the Apple IIe. I would be the first to tell you their products are not perfect. They just work better for me for what I do daily. So I figured some years ago I liked the product and it scores well analyzing it using the dumb method, a simple to understand and easily replicatable stock analysis process I developed that requires no Excel spreadsheets or fancy math or software predictive models. If you'd like to know more of how I use this system to analyze stocks, well, take a look at any of my stock analysis on the MGA Investing channel. DUM is an acronym. The D stands for Durable Competitive Advantage. Think of it visually as a moat around a castle. It's the company's ability to defend and acquire market share either by way of regulatory advantage, proprietary business practices, processes, or patents to defend their market share mid to long term from competitors. I don't think anyone would dispute the fact that Apple clearly has multiple competitive advantages across multiple product lines. It also has an easy to understand revenue model. That's the U in the DUM method. The first M, what I call M1, is focused on measuring management effectiveness. That's using 5 key metrics: ROI, ROE, ROA, debt management, and management compensation. Apple scores well on each of these. The second M, or M2, is the margin of safety. This is about determining the optimum time to buy the stock based on your target return goals. And Mr. Market, well, seems to present at least 1 or 2 times a year for an optimum buy-in opportunity. One of the other pieces of data that I like to sample when I'm looking at companies of interest is free cash flow. This is the cash left over after the company pays its operating expenses and capital expenditures. This particular measurement doesn't always apply to growth companies because there's usually not much cash flow in the early years, which in some cases could be actually years. Several years ago, when Apple looked like it was headed for $90 a share, now this was well before the split, I invested $22,000 over a short period of time despite the doom and gloom stock analysts and tech journalists were saying at the time. As I mentioned earlier, this $22,000 is now worth over $100,000 today. Now, I've since added more shares when Mr. Market puts Apple on sale for no apparent reason from time to time. My last purchase was back on May 4th, where the price was so good at $128 a share, it was hard to resist, so I picked up another 25 shares, although I already owned hundreds of shares already. Today, December 28th, at the time of this recording, those 25 shares are worth over $180 a share. So the question is, how did I come to my conclusion about Apple despite the many negative reports from the so-called experts? Well, let's explore this question. In addition to the company scoring well using the DUM method I discussed briefly earlier in this video, here are 5 reasons that supported the data that led to my decision to buy Apple stock. Number one, as I mentioned, I like the product. This is not necessarily a key criterion. I own two companies within my portfolio today that I've had for years that I don't necessarily agree with some of their business decisions, but they've made me so much money and they continue to score well within the dumb method. And I work really hard not to allow emotions to get in the way of business. Number two, they have always had a low PE ratio compared to its price per share. At least that's my opinion. Number three, they have a lot of cash on hand. And number four, they're innovative in the right ways. Number five, well, it's well managed. Let's take number one. You can hate Apple all day because you think they're overpriced. They don't have all the whistles and bells that other mobile phones have, blah, 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 and on and on. But at the end of the day, the record shows they keep selling and more people keep buying. And that has been the iPhone story since inception. That is undeniable. I have people I know that refuse to buy an iPhone because they hate the fact that so many other people have them. That's like me not liking hamburgers because so many people eat them. It just doesn't make any sense to me. Not only will they not buy the iPhone, but they also won't even buy the stock. But it is a free country and choice can be a good thing. Somehow though, I don't think that is nearly as bad as people that have owned nearly every iPhone made and don't own a single share of Apple stock. That to me is even more crazy. If I had the choice between the two, I'd buy the stock first with my $500 or $1,000, and with the gain I'd made after a year or so from the stock, I'd buy an iPhone later. That strategy has served me well with Tesla also. I bought the stock first, and then 6 years later, I bought the car. I thought it only made sense to drive the car I'm betting on for the future. I consider it sort of a reinvestment. Number two, Apple has a low PE ratio. PE ratio to me indicates how much people are willing to pay per future dollar the company earns. So in other words, if Apple's PE ratio is just above $31, which it is presently at this time of the recording, then it presumably tells me that investors are willing to pay $31 for every future dollar Apple earns. This is absolutely ludicrous to me. The company has multiple product lines that if you took each of them, separated them into separate companies, they each would make the top 250 on the Forbes 500 list. Seriously, the company had over $274 billion in revenue in 2020 and operating income over $66 billion, and its PE ratio earlier in the year was 36. You do the math. Number three, they have a lot of cash. Apple is sitting on a reported $190 billion in cash against about $124 billion in debt, which leaves them with a net cash of $66 billion in their war chest. There are few companies in better shape to weather an economic or market downturn than Apple. But then again, a lot of cash could present a challenge during an inflationary period, which we seem to be in the beginning stages of right now as real inflation sits around 7 to 7.5%. This means those billions are losing purchasing power every year. It will be interesting to see if Apple makes a Bitcoin play with some of those billions in 2022 as a way to protect against inflationary erosion of some of that war chest at some point. It seems most obvious if they can get the regulatory approval. There's not many places anymore it can go with all that money. They continue to make the necessary R&D investments every year. They'll buy some of their stock back in Q4 and Q1, which bodes well for us investors to continue to artificially drive up the value of the stock because for each share bought back, it reduces the total number of shares outstanding, which increases the price of each individual remaining share. There's only so many new companies they can buy that make sense for the company. Wow, see how quickly I went down the crypto rabbit hole? That's an entire video on its own. Number four, they're innovative in the real sense. I hear stock analysts, journalists, and everyday people say often, Apple stopped being innovative. That could not be further from the truth. What people mistakenly think Apple does is bring to market what Clayton Christensen in his best-selling business book, The Innovator's Dilemma, calls disruptive innovation. This is where you have a market we know least about, and it presents a strong first-mover advantage. That's not Apple's playground, and it's not their strength. Think about it. Apple wasn't the first to make the personal computer. They just made it easier to use for more people. Apple didn't make the first MP3 players. They just made it work better for people. They didn't create music streaming. They just made it easier to access from multiple devices. They didn't make the mobile phone. They just made it better in the way that people didn't know that they even wanted. They didn't make the first tablet, the first TV streaming device, the first smartwatch, earpods, or headphones. But yet, stock analysts, tech journalists, and everyday people keep expecting this disruptive innovation to emerge from Apple. Look, I'm not saying it couldn't happen, but Apple's history has shown time after time they have very little proclivity for first mover advantage. It makes me think about the Apple Wallet. I wonder just how long before the Apple Wallet includes cryptocurrency capabilities? It may be a while because they usually like to wait for a product to develop more market adoption before they jump in and simplify it. Sorry, there I go again with the whole crypto thing. And number 5, Apple is well managed. Apple had a succession plan in place in the event Steve Jobs either stepped down or was to pass away. Steve injected Apple with the innovation DNA to continue to evolve and resolve the conflict between man and machine. Another reason he changed the name from Apple Computers to Apple back in 2007. It's 2021, nearly 2022, and some investors are still confused. They think Apple is a home electronics company. And because of that, well, they're blinded by the entire purpose Steve Jobs changed the name of the company in the first place. As I mentioned earlier, Apple dances to the beat of their own drum, not Wall Street's, and it drives Wall Street crazy that Apple doesn't chase quarterly earnings. Another reason why Apple's PE ratio is so low compared to similar companies with less revenue. Apple takes a very long view of the business. Its leadership keeps single-minded focus on 3 things. Number 1, maintaining a culture of innovation, creating hardware and software, and getting them all to work together. Number 2, maintaining an active install base of over 1 billion. This is like having Coke vending machines, and every time a new drink is created, it gets put into circulation in one of those billions of vending machines. It is automatically, it's another $1 billion in sales revenue in drinks. Except in this case, it's iPhones. Number 3, customer satisfaction and loyalty in the industry. When you put all 3 together, it's a money printing machine. If you make great hardware and software that work well together, and the majority of customers is satisfied, and if they're satisfied, they stay, and if you add more real value over time and maintain satisfaction levels of those existing customers, they keep staying. If you keep innovating, you will keep pulling more customers off the periphery that you never would have had access to before. The better everything works, the higher the satisfaction, loyalty, and switching costs get higher, further cementing Apple's durable competitive advantage. If you don't like Apple, at least get a bite of the apple. There may not ever be another company like them ever again. So whether you're deciding to buy Apple, more Apple, or any other company, keep your processes simple and replicatable. As I said earlier, no one has a crystal ball into the future, not even me. I just take the best available evidence that I can see based on a done process and make the best possible decision. Do I get them right? Not necessarily. Sometimes I've had to wait 3 to 6 years to prove out my assumptions. Sometimes I had to cut bait because something else was much too good to pass to wait for my assumption to prove out. I rarely do this, but it has happened. There's no such thing as buy and hold forever. Think about all those folks that held Kodak, GE, and Ford stock for the last 25 years. You have to use sound fundamentals and reliable processes to help you with your buy, hold, and sell decisions. By doing so, you will win far more than you lose. And remember, you don't have to win them all. You just have to win more than you lose. Do you own Apple stock? Are you considered buying it? Leave a comment below as to why you bought shares or you didn't. If you found value in this video, click the thumbs up. And if you haven't done so already, click that subscribe button so you're amongst the first to get more real information about successful investing for real investors. I'll catch you in the next video.